Welcome to Economic Outlook 2021, presented by RBC. My name is David Prang, CEO of the Chamber of Commerce Brant.One, and it's my pleasure to welcome you to this event today. This is a dynamic time in our regional economy, with many opportunities and challenges ahead in 2021. As we are experiencing today's event in a virtual format, the Chamber is working hard to develop new ideas and concepts in event delivery to ensure safety, but also to promote engagement and community support to improve the business environment in Brantford Brant. We are in the middle of a second wave of a global pandemic. Most of the world is anxiously awaiting the outcome of the US presidential election earlier this week. Yesterday, the Ontario government released the 2020 provincial budget with record spending and also a record deficit. Locally, we have a housing shortage, an infrastructure deficit, but we also have record low unemployment rates again, and we are ideally suited for many industries, and many of our chamber members have many international customers as well. After today's remarks, there will be a question and answer period. Please join the discussion at Sli.Do.com, event code 26504. If you submit a question and we get to it, we have chamber face masks available for you as a thank you for your participation. I'll follow up with you directly. Thank you to our audience for joining us from across our region this afternoon, and to our partners, the Brantford Golf and Country Club, for developing lunch options for most of our local participants. Now I would like to welcome Melissa Jarman, Vice President, Commercial Financial Services, RBC, for Brantford, Norfolk, and Tillsonburg. Welcome, Melissa.
Thank you, David. Good afternoon, and thank you for joining us today. I have the privilege of introducing our featured economist, Desjardins, Deputy Chief Economist at RBC. Dawn joined the RBC Economics team back in January 2006. She is a key contributor to the macroeconomic forecast for Canada and the US, and is part of a team that is responsible for the interest rate forecast for both countries. Dawn delivers economic analysis to RBC's clients through a variety of publications and presentations. She is often interviewed by media from across North America to discuss developments in the economy and financial markets. Prior to joining RBC, Dawn worked as a reporter for Bloomberg Financial News in Toronto, covering the Canadian bond and currency markets, and was the Canadian bond market strategist for a major US bank for 10 years. She is a graduate of the University of Toronto. Welcome, Dawn.
Um, so thank you for dialing in to talk about the economy. I know it's unfortunately not the cheeriest topic at the current moment. I guess when we think back to 2020, we'll be thinking about all of the significant challenges we've faced, whether it's from the health perspective, but also from the perspective of our economies and our businesses and our jobs. As David said, currently, we are seeing pressures being exerted on the economy once again because of this second wave of COVID-19 and some of the measures we've had to put into place in order to ensure that we remain healthy and that we curtail the amount of infections that are going to go through Canada as we go through the days ahead. So what I wanted to do first is perhaps give you a little bit of a global context. Certainly this is not a made in Canada story. It is a story that is impacting countries right across the world. And of course, this does have an impact in terms of demand for our goods and services from a global perspective. When we launched the case numbers from COVID-19, over 47 million people having been hit with this virus. The fact that we have seen significant periods of pullback in terms of lockdowns in many countries in the first half of 2020. In fact, those lockdowns really had a significant impact on the economy. Global GDP in the first half of this year fell 12%, which is unfathomable, really, the worst year since the Great Depression. Well, over the summer months, we did see many economies, at least temporarily, reopen. And this produced a surge in economic activity. We saw growth numbers come up quite significantly. But this resurgence that we've seen in recent months, in our weeks rather, in Italy, in the UK, and even here in Canada, sets us up to have a much slower increase in the pace of growth in the fourth quarter of this year, this quarter we're going through right now. Um, and on net, what we think it means is that it's going to leave the economy contracting by about 4.5% in 2020. Again, these are huge numbers, and ones we haven't ever experienced before in modern times. Now, central banks and governments have done really quite an incredible job in terms of trying to support the economies as we work through this very difficult period. We've seen enormous amounts of funding going to households and to businesses across the globe. We've seen tax deferrals and loan guarantees, all aimed at supporting households and businesses. Central banks globally also doing the same, and we have certainly seen interest rates fall to rock bottom levels. In the case of Europe, even further into negative territory. And we have seen central banks use what were once called unconventional measures to support their financial systems, lately seeming that these are becoming more common. And certainly we've even seen the Bank of Canada embrace some of these non-traditional measures, as I'll talk to in a moment. But when we look at Canada itself, pretty much described the pattern globally, the same thing happening here in Canada. We saw a very sharp drop in economic activity. The lockdown in Canada, the most aggressive lockdown, occurred from mid-March to the end of April, and that really was sufficient to take the knees right out of our economy. We saw 2 back-to-back negative quarters, such that we saw about 14% of GDP being cut. Now, as we went through the summer, we did have sort of that period of time when the reopening got underway, and that started in May, and we are obviously more open than we were during those very deep, dark days. But so from May to about the end of August and into early September, the economy was on this reopening path. And that did generate significant economic activity. We haven't got the data firmly in hand, but what we're tracking is about a 48% annualized increase in economic activity in the third quarter, which again, astounding as that may sound. But these recent resurgence in infections and some more curtailments in terms of the activity we can actually interact with has set us up for a slowing in economic growth. We're looking right now at growth of about 1% in that fourth quarter. That's the period of time we're going through right now. On net, though, you can see what it leaves us with is an economy that is going to be down about 6% in terms of GDP over 2020. We expect that as we go through 2021, we're assuming here we're going to get some outcomes in terms of a vaccine. We know it won't be rapidly and easy to widely distribute, but we anticipate that we will get somewhere in terms of getting this situation under control, and that will support economic activity as we go through the course of 2021. But I don't want to leave you with the impression that that's going to be great and we'll be back to where we were. If you look at this chart, I just use it to highlight the size of the decline, the size of the hit to our economy that occurred during that lockdown period, that first couple quarters of this year. That's a significant drop in GDP. And even if we get that number we're anticipating, that 48% annualized increase in economic activity in the third quarter, we're still nowhere near where we were when we entered the pandemic. And that dotted line that's on this chart, that's just showing us where our economy would have performed should we have not hit COVID-19. So all to say that this is going to be a long journey to get back to an economy that we would have been experiencing should COVID-19 not have occurred. Now, of course, this has been also seen in our labor markets, certainly. We look at our unemployment situation. We entered in pretty good shape. Our unemployment rate was at a very low level of about 5.6%. But during the lockdown period, 3 million Canadians lost their job and our unemployment rate surged 13.7%. Now, more recently, we have seen a recovery in jobs, and that persisted. We got some jobs numbers today showing us another gain in employment in the month of October. And that's all good news. We have an unemployment rate, though, still at 8.9%, so much higher than it was. And as we go forward, as long as we're going to have these periods where we're going to have to pull back and scale back on activity, mainly activity that requires person-to-person contact, it means that it's going to be tough sledding to fully recover the rest of the jobs that we've lost. And it means that it's going to take time. So as you can see from this chart, we anticipate we will see our unemployment rate fall. But even if we get the growth numbers we're anticipating in 2021, we'll still be with an unemployment rate that's ending next year at about 7%. So above where we started before this pandemic. Now, this chart doesn't have today's data in it, but largely the data still is correct in that it aligns with what's happening. When we look at the areas of our economy, our labor market, and those gold dots indicate where we are to date. So we're netting out all of those job losses with the job gains that happen subsequently. And what you can see is that food and accommodation services, retail, trade, these are the areas where we have and continue to experience large job losses. And we anticipate this will be the case until we get the all clear in terms of COVID-19. These are the areas of our economy that will continue to lag. Another area is construction. Construction activity on the residential side certainly has been rising, but on the non-residential side, we have seen a significant pullback in activity as COVID-19 impacts played out through our economy. Now, manufacturing, conversely, we have seen an increase in manufacturing employment. Today, this chart I think has us at flat, but after today's data, we do actually see more people employed in manufacturing compared to February. So that's an area where we are seeing the expansion. But when we look overall at the economy, and this is just till the end of this year, but I draw your attention to the dark blue bars. Those are the ones that highlight where the soft spots for our economy will be as we go through the months ahead. And we anticipate we'll see some recovery through 2021. But again, the laggards will be in those industries where person-to-person contact is very important, including in that, of course, is travel and tourism, as well as restaurant dining and retail activity. Well, when we think about what the government has done in terms of trying to support our households, our workers, as well as our businesses during this tough patch, one area which stands out is the fact that we have seen so much income support being put into place. And the chart here is really just showing us the degree to which this has occurred. Because when we look at those labor numbers, what we have seen is that job losses have been at the lower end of the wage scale. And so what this means is that these income replacement programs that were put into place more than compensated or very close to fully replacing those incomes. And so for people who maintained their jobs, primary income, wages and salaries, those continued. But for those who lost their jobs, their income was, as I said, at least replaced by some of these programs. And that led to a significant increase in the amount of income. Now, that sounds great, but of course, we all know that that was an income surge that happened. We know that consumers also had the opportunity to defer some of their payments, and they did that. So what they did with the money that they were given was not go out and spend it, but in fact, well, they did spend it, as I'll show you shortly, but they certainly did a lot of savings. And the savings rate in the household sector in Canada surged to 28%. So showing some precautionary savings, people don't know when their jobs are going to be recreated. So they're keeping money aside. They're not sure when the government programs will end. They also know that those bills that they deferred, they're going to have to pay them. So they put some money aside. And we think that the savings rate will start to move lower as we get further along. People become more confident, jobs will be recreated, and we will see the savings rate come down. Now, when I said spending wasn't actually what they were doing, in fact, I misspoke because when we look at this chart, it does show you that spending activity has increased. It's higher than it was a year ago, and that started in the middle of June. So consumers started to spend. Now, what are they spending on? Well, it's not the same things that we normally would be spending on. It wasn't on vacations, it wasn't eating out in restaurants, it wasn't going to concerts. It was on things like groceries and digital goods, either for entertainment or because people were working from home, having to boost or bolster what kind of software and hardware they had. So that's where we've seen the big growth. Now, during the summer months, we did in fact see a pickup in those dining out options, but since we've seen some pullback because of the containment measures, that's one of the areas which has also come off the boil. Now, we're at the Bank of Canada, when we're thinking about what they've done, they have moved their policy rate to 0.25%, the lowest level they have. And they have also done that in rapid order. They cut their policy rate by 1.5 percentage points in the month of March. And the Bank of Canada did enter into a whole new realm in terms of policy. They've always had what they call quantitative easing in their policy toolkit, but they didn't have to implement that during the great financial crisis, unlike the US Federal Reserve and the European Central Bank. But this time around, given the gravity of the downturn in our economy, the Bank of Canada did pull this tool and start to use it. And they are purchasing Government of Canada securities. At first, they were doing that in order to ensure market liquidity and the functioning of our market and the fact that we could get those interest rates down. But they've since migrated as our markets came back online and continue to function quite well. They've changed the focus of their bond purchases. They're now trying to purchase securities to keep interest rates down across all maturity spectrums. Because even though their policy tool can keep very short-term interest rates anchored at a very low level, as you move further out the curve, you need some additional support to keep those policy rates down, or excuse me, those interest rates down. And this is what we've seen. The 10-year yield in Canada has fallen significantly. And as you can see from our forecast, we think that 10-year interest rates will remain below 1% even as we go through the course of 2021. Well, one area that this, of course, has helped has been the housing market. When we think to the shutdown and the fact that the housing market really collapsed because people couldn't transact, they couldn't go see houses, prospective purchases, but that just pushed that demand forward. And over the summer months, we saw a significant surge in home sales activity. Now, we'd anticipated that that pent up demand would have been satisfied as we got into the fall, but in fact, we continue to see significant home sales activity. Now, this is largely happening in the single detached and the low rise space. Condo demand has fallen. So, for some of the bigger cities in Canada, we've seen condo sales moved lower. But home sales, single detached and lower rise, have certainly continued to rise. And we've seen home sales activity hit all-time high levels in recent months. When I looked at the Brantford data, also seeing sharp increase in sales, but as David said, a supply constrained market. And so what you've ended up seeing is strong demand, not as much supply, and we've started to see prices increase. And that's certainly true throughout the rest of Canada in most markets. The outliers, again, being in condos where prices have started to stagger because there's more supply and less demand. Now, as we go forward, we do think that we will start to see some of the demand for housing weaken a little bit. One of the drivers, of course, for population growth, for housing demand, is immigration. And as we know, COVID-19 has certainly derailed immigration flows into Canada as we've gone through 2020. So we think that we'll see some weakening in demand. But having said that, not calling for any kind of crash, we know that rates will remain very low. We'll see this eventual jobs recovery as our economy works to normalize, and that will keep our housing market in good stead as we go, growing a little less robustly as we go through the course of 2021, but still growing Well, businesses, of course, have had an extraordinarily difficult time. And as the reopening occurred, we saw business sentiment improve. Of course, this recent resurgence and these additional containment measures has seen sentiment deteriorate a little bit. Now, when we look at businesses, we've seen 70% of small businesses reopen. That's the good news, but we still have about 30% of these businesses that are only partially open, and a much smaller margin of businesses that have actually had to close. Now, the data isn't all good. Some of the survey results suggest that if we have to go through another bout of closures, some of these small businesses will migrate into that completely closed bucket. But that is not what the data has shown us so far. We look at it on a regional basis. Well, for some provinces, not only have they had to contend with the shutdowns associated with COVID-19, but of course, lower commodity prices, in particular energy. And as a result, Newfoundland and Labrador, as you can see on this chart, and Alberta have seen a significant hit to their economy. We anticipate they're going to post the largest declines in economic activity this year. When we look at Ontario, more in the middle of the pack, as we go through the course of this year, it was certainly the case that Ontario suffered that significant hit early in the year. We've seen evidence of some recovery as we've gone through the third quarter. Again, the risk is that as we contain this virus, we see some slowing in the pace of growth in the fourth quarter of this year. On net, that leaves Ontario with GDP falling about 5.8% this year. But as we go through 2021, we do anticipate Ontario will in fact participate. We will see growth of 5.2%. Now, just like that first chart or the second chart I showed you, it will still leave Ontario's economy at a slightly lower level of economic output compared to the pre-pandemic level in 2019. But that loss will be something like 1%. So certainly not as big as some of the provinces, the energy producers, for example, where the losses will continue to be substantial compared to where we entered this crisis. So David, those are my prepared remarks. I'm more than happy to take questions from people who called in, or any questions you may have.
Great, thank you, Don. I appreciate your insight and certainly both the global, provincial, and local comments that you reflected. We have a couple of comments from our Sli.Do, a couple of questions rather from our Sli.Do app, and I encourage those in the audience to take a look, and would also incentivize that slightly by offering a chamber face mask if you ask a question, and we're able to get to that this afternoon. I guess most important, or one topic off the top there is the U.S. presidential election and the potential impact on what that means for the Canadian, U.S., and potentially global economy. Does the party in power, whether it's in the Senate or in the office of the president, does that have an impact on the Canadian economy, and what historically has that looked like?
Well, I think, it's interesting because, as you're citing, it does make a difference, the composition of power, whether or not the House has leaning towards one way that constrains the ability of the president to pass legislation. Now, I don't know what the results are going to be. Certainly, everything I'm reading today suggests that it will be a President Biden, but I'm not ready to make that call yet. But what in terms of that, I think when we think about the change in tone, if we do have a change in administration, for Canada, perhaps less uncertainty with respect to our trading relationship with the U.S. As we know, the Trump administration has been volatile on the issue. And not only did we have to renegotiate NAFTA, but we've been subjected to tariffs on our steel and aluminum. So I would think that even though historically Democrats tend to be less buying into the idea of the benefits from globalization and trade, I would think we might have a more certain road in terms of our trading relationship. Seems unlikely to us that there would be a renegotiation of any of our trade relationships with the US. In fact, one of the platforms I think the Biden campaign put out was that they would rejoin things like the Trans-Pacific or the CPTPP agreement. So again, setting up for global trade to improve, which is a good thing for Canada. The one thing on the energy file, the Biden campaign has said that they will put a halt to Keystone XL. So from a Canadian perspective, that would be a negative. Now we do have other pipelines underway, so that that may mitigate some of that hit from that. But nonetheless, these are the main things that we've been trying to watch. Tax policy, the Biden administration would be looking to reverse some of the corporate income tax cuts that were put in place by the Trump administration. So that would give Canada on the corporate income tax rate a bit of advantage. So it'll be a mixed bag. I guess my gut reaction is, they will get to work on fighting the virus in the initial stages. So all of these other policy issues, I think we'll have some time before we're seeing anything really implemented.
Okay, thank you. I guess another major topic that was, I think, pre-COVID in the news pretty consistently, especially around election time, is the idea of significant provincial and national debt and the deficits that have occurred annually, particularly in the province of Ontario, having the largest sub-sovereign debt of anybody in the world. Can you comment on what this debt load, both the Ontario budget coming in yesterday, having the largest spending record, and as well as the largest deficit record, something probably Doug Ford did not anticipate taking on when he ran for election. But can you comment on what the prior focus of debt and deficits by politicians, and the perceived disaster that we heard a lot about pre-COVID, and then now with all of the spending, and certainly much of it, as you noted, required, and definitely essential to keep food on the table and roofs over our heads. But can you comment on what that looks like moving forward? Like, how do we, if we were so worried and so scared about what a significant deficit looked like pre-COVID, and now we're almost welcoming it and not really understanding what it means to get out of it, or how we get out of it. What does that look like in obviously it's not a 1 or 2 year problem. This is a 10 or 20 or more. But what does that look like from your perspective?
Yeah, I mean, you're right. People were wringing their hands before the COVID crisis struck, and we had to implement all of that spending. When we think back, and I certainly have always been more of that. Let's just keep our fiscal capacity intact. Let's not spend when we don't have to. Even not necessarily having done that before the COVID-19, we were still in reasonably good shape compared to our global counterparts. And as we've been spending, of course, so have they. We've all had to, good prices raising all fiscal deficits, not just in Canada. The one thing I think that is a bit of a saving grace in this time, of course, is the fact that interest rates are so low. So, typically the big worry always becomes is if you grow up these deficits and your debt levels, we have to pay to finance that debt. And what does that look like? Well, this time around, with interest rates so dead low, it isn't as much pressure as it has been historically. If we think back to the mid-90s, I mean, that was one of the things. Interest rates were higher. And so when we were running these debt balances, we were paying an inordinate amount of our incoming funding, our tax revenues, just to support the debt. And that certainly isn't the case right now. And as we go forward, I mean, there will be concerns once the dust settles. How are governments going to attack this high level of debt, these deficits? How are they going to get their fiscal houses in order? Now, we have heard from the federal government that they're not going to announce any kind of fiscal anchor. And the fiscal anchor was really just saying, we have a deficit, we're going to get rid of it in 10 years. Or our debt level will go to, the most recent government was, our debt to GDP ratio will go on a downward trajectory. Given the heat of the moment, the federal government has said we're not going to do that right now, which, I guess it makes sense. But I think over time, we definitely need to know that. And rating agencies and foreign investors need to know that. Well, how are you going to do this? Give us some indication about what your plan is. I mean, today is probably not the day for them to have to do that. But I do think that as we go through 2021, presuming we do get control of this virus in the first half of this year, and as we move through the second half, I think that is one of the things. If you're going to keep the confidence of international investors, we need to show them that, we have a plan.
Okay, thank you. Speaking of plan, let's stay on the Ontario budget for a second. What with the budget that was released yesterday, and not a lot of time to prepare, but there a couple of maybe 8 or 10 topics on that were related to business within the government's release yesterday. What are maybe a couple of highlights that you were optimistic about, or you are optimistic about rather, that may help improve the economy in the province of Ontario?
Yeah, well, I mean, I think reducing electricity charges for some businesses, that has been a long-term concern of businesses. And I've been doing this job for a while, and it seems that that's always been a very big top of mind concern. And I think the other thing is the commitment to broadband internet. When we think about companies that have been able to manage a little bit more easily, and not that it's been easy for anyone, but it is the fact that they have access to being able to deliver their goods or services via the internet, and this is key. So for small areas where they don't have that connectivity, I think that's just a hurdle that is unnecessary, and one that it's good to hear that there's going to be money put against that to ensure that all businesses have access. I think that's a pretty important one. And of course, on the household side, just the societal side, the long-term care homes, all of these monies. I mean, these are things that are required right now.
Okay. You talked a bit about immigration, and certainly Canada's with our lack of being able to replace our population, immigration's been an important part of Canada's economic growth, as you noted. What does that mean really for the next say 5 to 10 years? Is that with COVID, there may be a reluctance to move and all that, but how does Canada and maybe in particular Ontario encourage I guess both the immigration as well as densification? If the most popular housing products are single detached and low rise, but we need to densify, there seems to be a bit of a disconnect between needing to bring in more people and to create more jobs and more economic activity, as well as then the dream of owning a house with a picket fence and trees in a backyard is sort of counter to, and the price of what that product would look like versus a condo, and the more dense relation of that type of product. So it seems to be a bit of a disconnect there. But how do you see that playing out over the next sort of 4 or 5 years, or even 10 years or so?
Yeah, I mean, I think what the government has done is they've tried to boost their targets. I mean, not sure that just because we move the level up doesn't mean that necessarily we're going to have the people come. Certainly, I think one of the ways people come to Canada is being a student. And once you're a graduate, you can be in Canada for 3 years, and perhaps just easing that transition to citizenship could be a way that we can keep people who, obviously these are skilled people. These are people who are um, educated in Canada in many cases. So that could be certainly one way we could help facilitate getting people to come to Canada and to remain in Canada. And as you're saying, I mean, certainly the case that we've seen, and this is something my colleague Robert has written a lot about, is what we're seeing right now is that people aren't necessarily, yes, home sales, single detached home sales in the bigger cities are very strong, but we've also seen that move out as well. As I said earlier, Brantford, we've seen these big surge in sales and price increases, and that price increases reflect a lack of supply. So it becomes the case, I think, that if COVID-19 has done accelerated trends, whether it's e-commerce or working from home, it does open the prospect that as people come to Canada, what could be an attraction is, you're not necessarily having to live in the downtown core anymore. You can live anywhere. And so it does allow for these markets, which, we have seen many cities see significant demand increases simply because people do want a bigger space. I mean, that's the other thing I think COVID has shown us is that it was great that you bought a condo when you're out all the time, but when you're at home all the time, the walls kind of creep in on you a little bit. So certainly that is one of the things we have been monitoring, and think that is one of the avenues that will keep Canada attractive. Because, as you say, we do need immigration to ensure our labor force continues to expand.
Okay. And we've reached the end of the questions that we have in our Sli.Do app. So is there any closing comments you'd like to make before mine?
Well, I mean, I think it's all to say is that, we are, it's hard to be overly optimistic until we know what's happening with COVID-19. Having said that, we have seen a lot of our businesses, as I said, open, and we are seeing jobs being recreated. So it is just that trying to keep that in perspective, and seeing that there is going to be supports in place either from the government side, with the Ontario government recently or yesterday announcing some and very low interest rates. So I think that mainly is what we are concluding here, is that it's going to be tough, it's going to be uneven, but we'll get there.
Great. Thank you, and we really appreciate your taking the time today to inform our listeners, our viewers, our attendees. And it certainly was as I said when we were preparing for this event. I like to take notes and see how the predictions from one year to the next reveal themselves. But as you noted, the tremendous uncertainty is going to create some interesting discussions throughout 2021. I'd like to thank RBC for sponsoring today's event. We wouldn't be able to bring this event to you without the help and support of our main sponsor presenter, RBC. So a strong thank you to Don and to Melissa Jarman, VP of Commercial and Financial Services at the RBC branch serving Brantford, Brant County, and Haldimand, Norfolk, and Tillsonburg. I'd like to thank Leslie Barker, who's a chamber staff, for organizing today's event. And a final thank you as well to Ashley McBeath, who was the initial lead on this project and this event for the last 2 years. She's moved on from the chamber, and today is her official last day. Thank you as well to Pigs Productions for their production efforts today. Once again, we've turned the chamber offices here into a television virtual video studio, and it was a pleasure certainly working with Pinks, and look forward to working with them in future events. I'd like to thank everyone for attending today, and please remember to stay positive, test negative, and get your flu shot. As well, I'd like to put a soft reminder out there as well to purchase a poppy, or to find another way of acknowledging our country's sacrifices in your own way on November 11th next week. Finally, a quick short announcement. We've just been able to confirm yesterday morning before the Ontario budget was released that the Chamber will be hosting a short roundtable with Ontario Finance Minister Rod Phillips next Thursday. So please contact me directly if you'd like a private invitation to that discussion with the Minister of Finance for the province of Ontario. Finally, again, test negative, stay positive, and have a safe, healthy, and happy weekend. Thank you.